The Trump administration is floating a controversial new plan to fix the housing market, extending mortgage terms to 50 years. They claim it will slash monthly payments and open the door to homeownership. It sounds appealing, lower monthly payments instantly, but the math reveals serious long-term risks. We are breaking down why this solution might actually be a generational debt trap. Today, we're analyzing the most controversial proposal in real estate. This video could save you hundreds of thousands of dollars over your lifetime. If you value independent, math-based financial analysis, show your support by subscribing and turning on notifications. Let's look at the data. Throughout late 2024 and 2025, the housing market has remained frozen. Mortgage rates are averaging 6.28%, and home prices are projected to rise about 3% in 2025. High costs have locked out first-time buyers. In response, reports from USA Today, CBS News, and Politico confirm that President Trump and FHFA Director Bill Pulte are pushing for government-backed 50-year loan terms. The argument from the White House is simple: lower the monthly payment, lower the barrier to entry. It's being pitched as a free market solution that doesn't require tax hikes. But as financial educators, we have to ask, is it actually a solution or just a rebranding of long-term debt? We are going to dissect this proposal into 5 critical parts to show you why this lifeline might actually be an anchor. Part 1. The payment drop math, the political selling point. The administration's main selling point is immediate cash flow relief. They want to show voters lower monthly bills. But does the math justify the hype? Let's look at a realistic 2025 scenario based on current HUD data. You buy a $450,000 home with a $50,000 down payment, financing $400,000 at 6.28%. 30-year standard. Principal and interest equals $2,470 per month. 50-year proposal. Principal and interest, approximately $2,280 per month. The reality? The savings are only $190. That's about 7.7% lower, but you are agreeing to 240 extra payments, 2 extra decades for modest monthly relief. This is a Band-Aid, not a cure. Part 2. The interest explosion, the wealth transfer. This is the part of the policy that lenders may favor, but consumer advocates warn against. By extending the loan term to half a century, you are allowing compound interest to run wild. 30-year loan. Total interest is $489,000. You pay for the house about 2.2 times. 50-year loan. Total interest is $898,000. The reality? You pay $409,000 more in interest to save $190 per month. That's nearly $500,000 transferred to lenders. While the administration frames this as helping the little guy, the mechanics suggest it primarily benefits banks and investors. We've just exposed a $400,000 difference. This is the kind of math that gets hidden in the fine print. If you appreciate us doing the heavy lifting to show you the truth, please hit that like button. It helps us spread this warning to more homebuyers. Part 3. The equity nightmare, the forever renter. The core promise of the American dream is building equity, owning a piece of America. Critics of the Trump plan argue that the 50-year mortgage destroys this benefit, effectively turning owners into what critics call renters who pay for repairs. In the early years of a 50-year mortgage, the amortization schedule is incredibly slow. You are paying almost exclusively interest. The data: year 10 on a 30-year loan. Balance is $330,000. You've built about $70,000 in equity. Year 10 on a 50-year loan, balance is $380,000. You've built only $20,000 in equity. The reality, if home values stay flat or dip slightly, you could be underwater for 10 to 15 years. Refinancing or selling becomes almost impossible. Part 4. The lock-in effect, stalling the economy. Economic mobility is crucial for the U.S. economy. People need to move for better jobs. However, this policy could inadvertently trap people in their homes. Because you build equity so slowly, as we saw in Part 3, when you go to sell the house in year 10 to move for a new job, you will likely have no profit to use for a new down payment. The scenario: you sell the house for $450,000, assuming flat growth. The costs? After paying agent fees and closing costs, 6%, and paying off your $380,000 loan balance, you might walk away with less than your original down payment. The reality, the 50-year loan creates a lock-in effect. Families won't be able to move for better jobs. This reduces labor mobility and hurts the broader economy. Part 5. The inflationary impact. Prop up prices. Finally, we have to look at the macroeconomics. Why is this being proposed now? Many analysts suggest it is an attempt to keep housing prices high to prevent a recession. The concept, basic economics, teaches us that if you increase buying power by lowering monthly payments without increasing the supply of homes, prices will rise. If a buyer has a budget of $2,300 per month, on a 30-year loan, they can buy a $400,000 house. On a 50-year loan, they can afford a $450,000 house. The reality, sellers and builders know this. The policy props up prices for current owners while burdening younger buyers with lifetime debt. It's an inflationary policy disguised as affordability. The 50-year mortgage is being presented as a tool for freedom and affordability, but the math tells a different story. Monthly savings are minimal. Total interest cost is catastrophic. Equity build is dangerously slow. Families risk being trapped in homes. Prices are inflated even more. While the political debate will continue, your financial decision must be based on numbers, not speeches. Be cautious about signing a contract that binds you until you are 80 years old just to save $200 today. I'm curious to hear from you. Do you trust this new proposal, or do you see it as a handout to banks? If you had to choose between renting and a 50-year mortgage, which one would you pick? Drop your answers in the comments and subscribe for more educational content on personal finance. Thanks for watching.